Thanks for tuning in to BQ Conversations. I'm your host, Niraj Shah. A lot has happened in the last 12 hours in that the Fed has moved contrary to market expectations with a fairly hawkish outlook. Now, that has implications for world markets at large, including Asian markets and Japan as well. Since the Japanese markets are the focal point of every Asian strategist, we thought we'll do a combination of Fed speak plus a view on Japan with Izumi Devalier. She's head of economics at Japan at Bank of America. She joins us right now on the show. Izumi, great having you. Thanks for your time. Would love to understand from you your thoughts on what the Fed has just done about 12 hours ago.
Well, yes, I mean, the decision itself to pause was not a surprise, but I do think that if you look at the statement itself and the path for the economy and inflation that the Fed presented in its so-called summary of economic projections and the dot plot, it was more hawkish, right? So the Fed is now signaling that it thinks that they're going to have to hike another 50 basis points in this cycle. They raised their forecast for growth while lowering the unemployment forecast. So that part is hawkish. But we actually think that if you look a bit closely at the decision, there's a little bit for everyone in this. For example, when Powell spoke after the Fed decision, he stressed that this decision only covers the current meeting, that the path for the economy is uncertain. So we thought that actually the press conference itself was slightly more dovish than the statement. What we think is going on is that the FOMC is now more divided. Last year, I think there was a very strong consensus to hike the interest rates aggressively in order to catch policy up in the face of very high inflation. But now that policy rates are well above 5%, and we're approaching, restrictive territory, I think there's a much more active debate within the hawks and the doves on the FOMC about how far to raise interest rates, how much more tightening is needed and how long to maintain these tight levels of policy. So what you see is, I think, the reflection of a divided Fed. I do think that going forward, they are truly data dependent. So if the labor market and inflation data continue to come in hot, we think that further hikes will be delivered. Our base case is 2 more hikes in July and September. However, if we do see some further improvement and softening in the labor markets and inflation comes down faster than we expect, we think that they'll just pause here for the time being.
Two questions rolled into one, and that's the part of my second question. The point that Jerome Powell made, that we are not looking at rate cuts for it. I mean, rate cuts are only 2 years out at the very least. So that kind of stood out for me. I don't know how you read into it. And the fact that from the looks of it, the US economy seems to be doing okay. Airports are full, QSRs are buzzing, and the economic activity out there is pretty strong. What would that indicate?
I think you're absolutely right that one of the very important missions that Chair Powell and the Fed wanted to accomplish in this meeting is to deliver the pause without having markets, price in rate cuts. I think the Fed is fairly satisfied with where interest rates stand right now and the level of tightening that is being delivered through monetary policy. However, we still have inflation above target, so there still needs to be some work done to bring demand and inflation down. So what the Fed does not want to see is for the markets to price in premature cuts, for that to lead to a loosening of financial conditions, which may lead to a reacceleration in the U.S. economy. So I think that's why the Fed, the Powell is emphasizing, and I think the Fed itself is indicating that it sees the need to keep interest rates high for a prolonged period of time. And that's a rightful concern to have, because if you look at the U.S. economy, you're absolutely right that spending has remained more resilient than I think we had expected. And if you look at markets like housing, it's shown signs of bottoming as interest rates peak out. So I think the Fed is, the economy still has a lot of momentum, and I think the Fed is wary of a reacceleration.
Got it. What does a decision like this mean for, let's say, Japan? And I would love to broaden it, but I understand that you track Japan very closely. So what you feel about what a Fed decision could do to Japan might well be something that maybe might happen for other economies as well. So tell us, what do you think of this decision for an Asian large market like Japan?
Yes. So, I mean, I think the Fed decision cuts both ways. So on one hand, I think the Fed has established very strongly that it needs to do more work if needed to bring inflation down. So that means that it's unlikely that the Fed will pivot in a dovish direction anytime soon.
Right.
It's very unlikely that they cut rates this year, even early next. So if the BOJ were looking for a Fed pivot to give them the opportunity to loosen, YCC, without creating a lot of volatility, I think they're not going to get that timing necessarily. So it just means that it raises the risks that actually, the yen continues to weaken, adding to inflation pressures. And I think it limits the ability for the BOJ to wait and see what happens before changing policy. I think it adds a little more urgency for the Bank of Japan to move.
Interesting. But I read your note for the policy tomorrow from BOJ, and you believe that the markets would be disappointed if they are pricing in a change, because you expect a status quo, if I'm not wrong.
Yes, we expect a status quo, no change at this week's Bank of Japan meeting. I do think that is the consensus. So I don't think there will be a big disappointment if the Bank of Japan indeed keeps yield curve control and policy settings unchanged. I do think, however, that Bank of Japan policy changes are a matter of time. They have a very complex policy framework right now where they're targeting and controlling interest rates at the long end, 10-year JGB yield, as well as maintaining negative rates policy on the short end. Now, we think that the Bank of Japan, is willing to remain behind the curve when it comes to short-term interest rate hikes, which do matter more for the economy. However, when it comes to yield curve control, the danger is that the longer they sit on this policy, the easier financial conditions become. It risks stoking further weakness in the yen. And makes their communications difficult. So we think that the BOJ's first priority is to loosen its control of long-term yields. And we believe that by July meeting or latest October, the Bank of Japan will continue to deliver the next move in its normalization process.
What kind of impact could that have on risk assets in Japan? Because frankly, for every Asian manager, the Japanese equities are the ones to look for. Almost everybody says that, hey, not even India, we are focused on Japan as the key area where we want to go out and look for investing. What is your thought on what the BOJ policy, the pivot as it happens a couple of policy meetings down the line, mean for risk assets?
And that's a great question. But my short answer is that if the Bank of Japan is going to continue moving in the cautious, gradual manner that we expect, we don't think, risk assets will suffer much from such a move. We are, at the end of the day, we are talking about a very gradual loosening of long-term bond yields. That has a very minimal impact on the real economy. And if you think about it, if you compare what the Bank of Japan is doing versus the Fed, the ECB, and other developed market central banks, interest rate policy still remains very, very easy in Japan.
Yeah.
So the policy stance is still very stimulative, and we think this is going to support Japanese risk assets, and also will be a headwind for the yen.
Okay, and why is Izumi, I'd love to understand from you, the broad picture might be known, but you can delve into detail and tell us, why is the Japanese economic picture different this time than what it has probably been in the last many years?
Yeah, so I think there's several, different aspects of the cycle that make us a bit more confident that the changes that we're seeing in the Japanese economy, labor markets, and inflation will likely be longer lasting and structural. So number one is the growth environment. In Japan, we have had some false dawns where inflation and growth spending started to pick up, but they were always short-circuited by U.S. recessions. Now, this time around, our U.S. economists are expecting some modest further slowdown in the U.S. economy in the early part of next year. But we think because of some momentum in inbound tourism spending, the reopening of Japan's domestic economy and the fact that domestic wages are picking up, that this time around, because of that strength in domestic demand, Japan can avert that recession to keep the cycle going. Secondly, on inflation, again, historically, we have seen a weaker yen and higher import costs push up inflation, but it didn't last because corporates, did not hike wages in response to the rising prices. However, this time around, corporates have been hiking prices aggressively, but they've also been redistributing the proceeds of those profit increases back to workers, and we've seen the strongest pickup in base pay in 30 years. So we think this could also sustain the cycle. And then the third final point is the behavior of the yen. Again, in the past, Japan's reflation has been short-circuited by an unwelcome appreciation of the yen. This time around, with Bank of Japan keeping policy relatively easy, and also structural flows preventing a very sharp appreciation of the yen, we think it will give Japan time to re-anchor inflation and inflation expectations.
Okay. My final question, Izumi. You've spoken in this interaction about how you believe the Japanese economy will avert a recession. I think the note suggested that as well. Now, does the possibility that the US might also do the same, because while a recession is being spoken about ad nauseum for the last 6 months, the activity doesn't seem to be suggesting that. If anything, it's pushing the possibility of a recession further away. So is the possibility of the US also doing the same adding to this belief, or could Japan do that even if the US unexpectedly slips into a recessionary scenario in calendar year 23 sometime? Could Japan still avert a recession? Because usually it's started at the hip, right?
Yes, I mean, historically, every single U.S. recession since 1960 has dragged Japan into one. But in this case, so long as the downturn in the United States remains mild, I think Japan will avert a recession this time because of the differences in the manufacturing cycle. And again, these unique tailwinds coming from the reopening and the tourism boom.
Great. Well, it was a pleasure talking to you, Izumi. Arigato gozaimasu, and looking forward to talking to you more often.
Arigatou gozaimasu. Thank you very much.
The